I'm really excited to introduce our next panel, which will be moderated by David Yermak, who is the head of our finance department here at Stern. And he has some really exciting things to showcase about the latest in FinTech research. So take it away.
Thank you. This session is about academic research, and the three speakers kind of won their way onto the program through open competition. To be a little more clear about this, one of the leading peer-reviewed journals, the Review of Financial Studies, had a competition for a special issue on FinTech, sort of hoping to jumpstart academic work in the area. And I believe there were 150 submissions, which was just astonishing that so many people were already working on this. And among that group, ultimately 10 were chosen to be part of a special issue. And we invited 3 of those 10 to present their work here. So we'll hear from each of them for 15 minutes each. The first speaker from the University of Maryland will be Francesco De Cunto.
Great, thank you, David. And today I will discuss why we should care about robo-advising and why robo-advising is important, especially for those investors that need financial advice the most. And I will do so through the lens of research I conducted with my colleagues at the University of Maryland. So why did we decide to study robo-advising? Well, because as you all well know, all of you sitting here in the audience, financial advice is one of the areas that has been mostly disrupted by the recent interventions in FinTech. When we think about the FinTech advisory space, it's actually very hard to even keep track of the new players, the new entrants in this area, as you can see from this graphic. And I guess many of you are actually representing here today some of these new companies and entrepreneurs. But so what is robo-advice exactly? We believe that 2 features are distinctive. The first one is providing automated advice, which is not worse quality than what human advisors could give, but it's much cheaper in price. But the second crucial distinctive feature of robo-advising, which is often neglected when we think about it, especially in practice, is providing a very easy way to implement the advice that investors receive. And it is really this very feature that we believe we find in our research is crucial to make robo-advising much more powerful than typical human advice. So why do we believe that? Well, first of all, this is exactly what the users of robo-advising tell us. Here in this graphic, I'm showing you what are the main motives for individual investors to use robo-advising, as they told BlackRock when they were interviewed for their 2015 Investor Pulse survey. And we see that by far and large, the most common motive is the convenience and simplicity to execute advice that these people find whenever they interact with robo-advising machines. Other typical motives we think often about, such as lower costs, or the fact that the quality of the advice is not worse than those of human advisors, seems to be less relevant motives to individuals. So this is exactly what makes robo-advising especially suited for this space, advising individual investors. We know that individual investors often make mistakes. They do not really know how to use their money or how they should invest. And the traditional way to solve this problem was referring to financial advisors. But even these advisors themselves, of course, might be biased. They might even have conflicts of interest, apart from being very costly. So robo-advising seems to have the most of its potential exactly in this segment. At the same time, though, so far, we haven't had so much evidence regarding the effects of robo-advising on investors' performance. So is robo-advising good for everybody, for every type of investors? Well, actually, no. This is what we find in our own research. So what we did is we paired up with a large brokerage house in India. They have about 100,000 individual accounts at the retail level. And in July 2015, this company introduced the robo-advising tool, which they call Portfolio Optimizer. So what does this Portfolio Optimizer do? They take the holdings of these individual investors, of their clients, and they re-optimize the weights of the assets these individuals have in their portfolios, also proposing new assets in which these individuals could invest in order to become more diversified. Now, a crucial feature of this portfolio optimizer compared to many others that, for instance, we have seen in Europe or the US over the last 5 years is that execution of this advice is extremely simple. You just need to click on a button in order to execute all the trades that the robo-advisor suggests you to do in order to optimize your portfolio. And so here in this slide, I'm showing you actually the interface, the graphic interface of the portfolio optimizer we study. In the left screen, you can see that the portfolio optimizer obtains the existing allocation of the investor's portfolio as of that point in time. On the right screen instead, that's where the optimizer computes optimal weights and shows very explicit and vividly, even graphically, why the portfolios that are suggested from this optimization procedure are superior to the portfolios that investors already hold in their own account. Now, crucially, what I'm circling here in red is a simple button that investors can click. By clicking this button, all the trades that are needed in order to maximize the portfolio can be executed immediately in batch mode. Now, we find that this very simple intervention is the one that allows individual investors to take up advice much more in this condition than what they would do with financial human advisors. And so what is the effect of using this type of technology on investors' performance? Well, what we normally care first in terms of performance for individual investors is diversification. So what we did first is we looked at the change in the number of stocks that these individuals hold in their portfolio after using the portfolio optimizer compared to before. And what I'm showing you in this graph is the average for this change in number of stocks based on how many stocks individuals held before using the optimizer. So to the left of this graph, the bar shows you what is the change in the number of stocks for those that held at most 1 or 2 stocks in their portfolios. These would be investors that were very little diversified before usage, what I would call the least sophisticated investors because they were not aware of the fact they needed to be diversified to begin with. The more we move towards the right instead, the more we have investors that held more stocks in their portfolios, so I would suggest these would be more sophisticated. They at least knew they should be diversified. And we see that the effect of the optimizer decreases dramatically with the level of sophistication. It's only those individuals that held very little amounts of stocks which increase their diversification dramatically by, on average, about 80%, whereas the effect decreases and becomes marginally negative for those that held more stocks to begin with. So does this effect on the number of stocks also translate in some other measures of diversification, such as the volatility, the risk of these portfolios compared to just what is the market risk? This is the second outcome we looked at. And even here, we find similar patterns as the ones I've just shown you. So we do find that volatility of portfolios decreases substantially for those that didn't hold many stocks at the very beginning. And this effect declines monotonically. It becomes very little, marginally, actually even appreciable for those that held more stocks to begin with. So the first outcome we care about is diversification. The second counterpart is the returns of these individuals. So what is the performance of these portfolios? And this is what we look at next. So here what we look at is the performance of the overall portfolio after using the optimizer compared to before. We see that, again, the segment of individuals that gain from using the optimizer is actually only the one that held little stocks at the very beginning. So exactly those people that were the least sophisticated. We failed to find any effect for those that held more stocks before. But then these, of course, are returns gross of paying fees to the brokerage house in order to implement the trades. So one might worry that all these additional returns the investors have might be eaten up by the fees they have to pay to the brokerage house. So what happens to the fees after using this optimizer? Here, interestingly, we actually find exactly the opposite pattern. So those people that were gaining the most from the optimizer do not pay more fees now, whereas those that are paying more fees are exactly those people that were not gaining anything from using the machine. And we find that this is the case because these individuals start to use the optimizer too often. And then the optimizer doesn't really change their returns that much, but at the same time, they trade much more than what they used to do before using the optimizer, therefore increasing very much the amount of fees that they're paying. And so overall, it seems so far that what we find is a very different effect of using the optimizer on different types of investors. Those that were the least sophisticated, that needed financial advice the most, are exactly those that increase their performance, decrease their volatility. To the other hand, those that were more sophisticated not only don't have any improvement, but in addition, they also pay higher fees. So what should we do? Should we tell these people, the most sophisticated investors, that they should not access robo-advising? Or is there anything that can also gain from accessing this type of technology? Well, we find actually there is something that even the more sophisticated have to gain. And we find this by looking at typical behavioral biases or investor mistakes that traders tend to do very often, both in the US and in other countries. Now, in particular, we look at three of the most famous of this type of mistakes: the so-called disposition effect, the tendency to sell stocks that are losing too late and stocks that are gaining too early; trend chasing, whereby investors try to buy the stocks that have increased very much over the last few days in order to try to ride a wave of positive return, a pattern that they feel they see in the data; and finally, the rank effect, whereby investors sell the best and the worst stock performance in their portfolios, but they forget about all the other stocks that could be churned. And what we find is that actually the presence of these biases in trades declines dramatically after using the optimizer for all investors, including exactly those guys, the more sophisticated, for which we didn't have a direct effect on performance. So over the long run, we might expect that by decreasing this amount of biases, there could be something to gain also for this type of guys. But so to go back then to the question I asked at the very beginning, so why should we care about robo-advising on a broader, more high-level view? And what my colleagues and I think is that robo-advising really is a new paradigm when we think about the effect of intervention on investors' behavior. So far, I mean, we would think we have been working mainly with two paradigms. The first one, which I'm calling in the slide here, libertarianism. The idea is that people know for themselves better what is good for them. So we should never intervene in telling them what they should do. To the other end, to the opposite, is what I'm calling here libertarian paternalism, which has been proposed, among others, by Dick Thaler, the author of the book Nudge, which just won the Nobel Prize for Economics a few weeks ago. The idea here is that we, as academics, as the government, as technicians, know better for people what is good for them, and so we should impose nudges and default behaviors on them in order to make sure they also take this type of approach. And so the way we see robo-advising is really a new paradigm that falls exactly in between these two older paradigms. The idea of robo-advising is that it does provide technical knowledge that people wouldn't have, and so it provides better choices for them, but at the same time, the final decision, the final action is always in the hand of the individual investor. So we will never impose on them. This is why we think of robo-advising as a paradigm that empowers individual investors as opposed to imposing on them. Right, so thank you all very much for your attention. I look forward to the rest of the conference. Thank you.
Okay, thank you, Francesco. The next paper will be presented by Matthew Plosser of the Federal Reserve Bank of New York.
Thanks, David. This is joint work with some colleagues at the New York Fed and Philip Schnabel, who's a professor here at NYU. And in this paper, we're really looking at how technology is changing the residential mortgage market. So in the last 5 years, there's been a rapid adoption of certain practices in the residential mortgage markets that's changed how loans are originated. The typical classic origination of residential mortgages is focused on branches and brokers, and these brokers are located in physical locations. They collect documents and they do underwriting in these various branches of banks and personal interaction with the borrower. But the new business model is very much focused on the internet and being able to take these materials remotely directly from applicants, centralizing the processing of these materials, and automating the underwriting of these materials in a way that very much increases the efficiency of banks and their ability to quickly underwrite and issue a residential mortgage. So what is the classic example of this? It's going to be Quicken and their Rocket mortgage product, their push button, get mortgage. You can completely apply online. You can get a pre-approval in less than 8 minutes. And you can submit much of your documentation online. And they've even automated much of the underwriting process. And their operations are highly centralized. They don't have underwriters spread throughout the entire United States. They have centralized centers where they do much of the processing of these applications. So where was fintech lending in 2010 in this space? Well, here we have a chart that indicates what the market share was in various US commuting zones. You can see it existed, but the fintech lenders that we identify had relatively low market share, 2.1%. By 2015, it had more than tripled. It was 7.4%. And you can see that there's significant geographic variation. It's not tied to any particular center. So this is a rapidly growing space in the residential mortgage market. And we're going to ask 3 questions in this paper. We're going to ask, is it more efficient at processing mortgages? Does it look like these fintech lenders are doing something different that's better than what already exists? Can they more elastically supply mortgages? Are they more quickly able to meet the demand for mortgages when mortgage demand is high? And then lastly, does something about the availability of these mortgages improve the decisions that households make about refinancing? And the alternative to all these potential benefits is possibly this is just about marketing or regulatory arbitrage. Is it that these fintech lenders are really just outside the purview of the typical supervisors who oversee the origination of mortgages, and therefore this isn't really about their technological advantage, but something about their how they've avoided particular regulations. And why do we want to study fintech in this particular market? Well, what's nice about it is it's a market that's adopted some of these technology improvements early. So there's a lot of data, and that means we can observe it so we can answer some of these questions. The other reason is it's the most important consumer borrowing market. It's 70% of all consumer borrowing. It's a huge market, and fintech is growing as a portion of it. And it's also a market in which people make mistakes. Households have been shown to make suboptimal refinancing decisions, suboptimal borrowing decisions, and so there's scope here for fintech to also be a solution in that front, and that speaks a little bit to the last paper that was focused on robo-advising. Is there a way in which these fintech offerings can help people improve their borrowing decisions? And from a policy perspective, this mortgage market is an important channel for monetary policy. As interest rates move, households readjust their balance sheets, the cost of their mortgages change, and understanding how monetary policy transmission could be affected by changes in the mortgage space is important for thinking how monetary policy may change in the future. And lastly, there might be implications for other lending markets. This is a market that's adopted this early, but there's scope for this to benefit many other types of both consumer and corporate borrowing markets. So what is the borrowing process in the US for a mortgage? Well, typically, consumers go and they shop for rates, they get a pre-qualification, they then submit a mortgage application and they get a pre-approval. The pre-approval is important for them to be able to actually put in a solid offer for a home. This pre-approval is usually issued by a loan officer, but they haven't done the full underwriting of the mortgage yet. That is something that takes place afterwards, but it's based on the initial information that an applicant submits as well as their credit score. And then after this process, once they have a signed contract, the borrowers will submit additional information and the whole loan will be underwritten. And that underwriting process is actually a very time-consuming process. It involves employment verification. It involves going through all asset accounts and deposit statements to make sure that the money that's being used as the down payment isn't borrowed or it can be accounted for. And this process is actually where a lot of the labor comes in the issuing of a mortgage, because an individual has to go through all of these things and verify them. And this is a key component for where automation has come to play, as people can submit their login for their bank account, which allows the underwriter to quickly verify what does it look like their direct deposits are from their employer, It can quickly verify where does the money look like it's coming from. And all of these things have really reduced the amount of labor that goes into the process. And this is a key area where FinTech has started to shorten the processing times for residential mortgage applications. So how do we identify FinTech's lenders? How do we define them? For our purposes, we're going to use something that we can observe, which is the online application process. And we're going to use this as indicative of whether or not these firms are technology-oriented. How much can you get done without talking to a person? How much can you get a pre-approval without actually talking to a loan officer? And so we went through the top 100 non-bank issuers of mortgages and identified those that looked like they could automate this process the best and classified them as FinTech lenders. And this has actually increased over time. So we used Wayback Machine, which allows us to evaluate these web pages historically to see, well, maybe I can look at it in 2018, this looks like a FinTech lender, but what did they look like in 2012? What did they look like in 2013? And when we do that, we can see that in the earlier period, from 2010 to 2015, there were really less than 5 FinTech lenders that we could identify. But in the last few years, which aren't going to be what we study in the sample, you can see this number really explodes. So clearly there is some dissemination of this technology in the space. It's not always clear that the front end, that the application process is being backed up by this automation of the underwriting process, but it's very clear that from the consumer-facing perspective, there's much more supply of these FinTech pre-approvals online than there was in the earlier period. But we're going to be focusing on this earlier period, so we're really going to be focusing on these 4 or 5 lenders that had these applications online from 2010 to 2015. We're going to use a lot of data. I'm not going to go through it. No time. But the key data source we're going to be using is the Home Mortgage Disclosure Act. It records every loan application that is made. So we have over 45 million observations in this time period. And we're going to look at the processing time, the time from which the initial application was made to the time in which the loan closed. And we're going to see, are these processing times different for these mortgage, these FinTech lenders? And we're going to control for a lot of things. We're going to try to control for individual characteristics of the borrower. We're going to control for where they live. We're going to control for the geography. And what we find is that the FinTech lenders have lower processing times by approximately 10% or 6 to 10 days. And you think of that, the average processing time is somewhere between 40 and 50 days. That can be pretty significant. And we find these results are similar whether we're comparing these FinTech lenders to non-banks or we're comparing them to the whole universe of both banks and non-banks. And there's really no evidence that these borrowers are more likely to default. So in fact, there may be slight evidence that they looked a little safer. So it doesn't look like there's a trade-off here between processing time and then risk. It's not that these applications look like they've been treated in a cursory way, which has increased the risk. So from our initial results, it really looks like these FinTech lenders can process these faster. And this is important because the processing time is a cost. You both lose buyers due to fatigue if it takes a long time to get to closing and underwrite the application. But you also are typically issuing a rate lock. And the longer that rate lock, the more costly it is for the lender to issue that mortgage. And so as these processing times come down, the costs of just mortgage issuance in general can decline. So the next question we ask is it more elastic? Are these lenders better able to respond to demand for mortgages? Can they ramp up their supply when mortgage demand is high? And this is a little bit tricky because demand and supply can be confounded when you want to analyze these things. And so we're going to have an empirical strategy where we just look at aggregate demand for mortgages. How many applications are coming in? And we want to see how does processing time respond to that. And we can see here in aggregate, the median processing time highly covaries with the aggregate amount of application volumes that come in. So when it's very busy, processing times spread out because these underwriters that we have said are very labor intensive, they're busy, their docket is full. It takes them time to get through all these documents, to call everybody that they need to employ for employment verification. And so the idea is the more automated this underwriting process becomes, are you able to respond to this demand without extending your processing times? Are you able to quickly close these loans and not lose potential lending opportunities? And so what we do is we regress this processing time on a fintech, and we interact that with application volumes. So what you can see here is that as application volumes increase on the y-axis, the fintech lenders, the red line, their processing times, they don't increase very much. Whereas if we look at mortgage banks, their processing times, they slope upwards. And then for banks, even more so. So that as they get busier, their processing times increase. And this is consistent with how we think about how these different types of lenders are organized. You think of banks are really very much like a hub and spoke. A lot of this stuff is being done in remote offices and individual branches, whereas for the fintech, that's the most centralized and the most automated. When times get busy, they can continue to process the loan applications efficiently. So the last thing we think about is, does it impact refinancing efficiency? So there's a lot of work that's been done in the consumer lending space that suggests that homeowners don't refinance their mortgages at the optimal time. So they either do it too late, so that they should have been doing it when rates fell, but they didn't, so they've been paying too high an interest. Or they do it too early, in which case rates fall a little bit and they refinance, they pay all these fees, but it turns out rates fall again tomorrow and they missed that opportunity. So fintech has the opportunity to make, if it makes refinancing easier, it's possible that we now get borrowers who are more likely to refinance when they should. And so our preliminary evidence here suggests that borrowers from the fintech lenders are more likely to refinance as rates fall, although we're still doing work to understand, is it really optimal? There's a point at which people could start refinancing too quickly. But it does look like someone refinancing with a fintech lender is going to more likely refinance as rates fall. And so given the topic of the session, I wanted to say something about disruption or adaptation. How does this disrupt the current mortgage market, and how much of the current mortgage market can adapt to this? And as I've spoken a little bit about this, there's two real models in this space. There's a centralized model, and there's this hub and spoke model, which is supported by branches. And so while the banks can certainly adapt by putting these mortgage applications online, it's not so clear that these mortgage applications, they can easily centralize their back office operations. Loan officers have a lot of clout within these organizations. They are also the people who bring in a significant portion of the mortgages that they issue. And they often have underwriters who sit next to them, and they like that because they can manage the process. So moving these underwriters into a centralized location creates a lot of tension within these organizations. So there's an extent to which it's not so clear that banks can easily adopt the practices that these non-banks, that these new fintech lenders use in order to make the market more efficient. That being said, banks have something that a lot of these institutions don't have, and that's balance sheets. Banks can issue more. All of these non-bank lenders that I've been talking about, or these fintech lenders, they're really securitizers. They don't have large balance sheets. They don't hold these things on their balance sheet. They're using government guarantees and securitization programs to move these loans somewhere else. And so the jumbo market is a market that's typically, where banks typically hold these loans on their balance sheet, is much more resistant to these inroads, because these fintech lenders, as they are right now, aren't in the best position to have cheap capital and large balance sheets in order to hold these mortgages, whereas banks are somewhat uniquely positioned to do that. So there's somewhat of a firewall there in what banks can do versus what these non-banks can do. So just to sum up, is fintech lending more efficient? It certainly looks like it. It looks like they can process these loans faster. Is it more elastic? It does look like it improves the elasticity of mortgage lending. Loans are more quickly issued when times are busy. It reduces these bottlenecks in the mortgage origination process. And it remains to be seen whether or not it actually improves consumer decision-making. That's something we're working on. But it does look like consumers are more likely to refinance from a fintech lender. Thanks.
Thank you, Matt. The final presentation will be by Boris Vallet of Harvard Business School.
All right, I hope you guys are not too tired by all these technicities, but then we are about technology. So let me throw you a bit more at you. So I thought it was very interesting, the keynote this morning, seeing how venture capital think about the sectors they want to invest in. And as researcher, we kind of do the same thing. I mean, I could have written a paper about blockchain. I could have written a paper about payments, except my criteria to choose an area is not how much money I'm going to make out of it, although I wish, but more whether there is something economically interesting happening in this market. And when I looked at the fintech area, I thought where something was fundamentally different, where is a business model mapping into an interesting economic question, I thought the marketplace lending was a very good area for that. And the reason for it is that it has the potential to fundamentally change the banking world as we think of it. And obviously, there's been a ton of research about banking, but a very important ingredient of this research is that investors in bank, they are not the ones selecting the loans. Whereas on Lending Club, on Prosper, the investors, they actually pick loans one by one. They are the ones that do the screening, and that's a fundamental shift in the banking model. That's what I would call a change of paradigm. And what is, why is this model developing nowadays? It's because the hard information is taking over the world. Obviously, when everything was about soft information, it was much harder to empower the investor to do the screening themselves. And that's why we needed the loan officer to have coffee with the borrower, to shake hands, and to assess the person. But now that we can just quantify people with 200 variables, it seems that there is a much stronger case for having a robot process these 200 variables about the borrower and then make an efficient lending decision, which is not based on how his or her handshake felt when they had coffee together. Okay, so we have this platform that are developing, and most importantly, it used to be called peer-to-peer lending. As you can see, I'm calling it marketplace lending, and the reason for that is that the second P has disappeared. So you should not think as your neighbor lending on Lending Club. You should think as a hedge fund, as a pension fund. So sophisticated investors that are therefore more and more equipped with machine learning tools, for instance, to do the processing of the hard information that is provided to them. Okay, so that's kind of the landscape and what I think is fundamentally exciting about marketplace lending. And I know Lending Club has been taking a beating in the news these last 2 years, but I strongly disagree with this beating. I think there is something fundamentally deep about what they're doing and that has really the potential to change. So if I was richer, I would invest in Lending Club. All right, which I'm not, so this is really, I have no conflict of interest here. So the research question, how this maps into the research question we want to address in a rigorous and quantitative analysis. So the first question is whether once we have these platforms that deliver all these variables to investors to pick the loans, is it the case that sophisticated investors will be consistently better at picking loans than unsophisticated investors? Because there is still some mom and pops making a lending decision on this platform. And so we should first make sure that the machine learning are actually beating the mom and pops that are making some lending there. And then taking a step back, we can think whether this difference in performances in allocating capital will vary depending on the marketplace design, how many variables are provided to this lender to make their decision. Typically, how large are the buckets that you group the borrower into? You know that Lending Club and Prosper, they have grades A, B, C, D, and so on. And so imagine if you were only giving one bucket, only A's loans, that would make it much harder for investors to pick the loan. And so the ultimate question we want to get at is whether this model is more efficient at allocating capital than the traditional banking sector. All right, and so I kind of touched about that already. What I think is very interesting here is that we are at the crossroad of understanding the value added of a fintech business model, and then also thinking intellectually about an economic friction, in that case, asymmetry of information, and how the banking system, what form the banking system should take nowadays to optimally tackle this asymmetry of information. So that speaks to the scope of banks. So maybe the screening should not be done by banks and only by investors. That's one of the open questions that this new paradigm is asking. All right? So we start with some theoretical analysis to structure our empirical analysis of the data. I mean, you know that in machine learning, you don't put any hypothesis. You just run everything on the data and you let the data speak. Why economists, we are not that crazy about this methodology is that it's very easy to get spurious correlations there. It's very easy to get relationships that actually are not true. And that just so happen because of noise in the data. And the way we try to make sure that this doesn't happen to our analysis and that we are not establishing relationships that doesn't exist is that we make sure that there is an underlying economic mechanism that can motivate the findings we find. Which is why we go through all this trouble of writing very complex equations that no one reads except us, but to make sure that there is actually a rationale for finding the result that we are looking for. So I'm going to be extremely parsimonious here. I'm going to spare you all the equation, but basically the way we think about it is that it's a sequential problem here. You first have lending club that is deciding on whether or not to pose the loan on their platform. Okay, so they are facing a pool of applicants, and then they are going to make a first decision on which applicant will happen on their platform. So that restricts the pool of applicants. And then you have a second screening that takes place, which is done by the investors, and that's where it's fundamentally different from banks, because banks, there is only one screening happening. There is only one entity that is screening, whereas here you have, as I said, two parties that is screening. And so, conditional on being on the platform, then you have the investors that come in, and especially the sophisticated one, that apply a second layer of screening to that to decide whether they want to invest in these loans or not. Okay? So under this way of thinking about the marketplace lending, we basically have derived hypotheses that we are then going to test in the data. And these hypotheses are the following, that sophisticated investors are going to outperform the naive investors. The second hypothesis is that the amount of information the platform provides to the investors is going to matter. So the more information you provide, the better the chance of the sophisticated investor are. So imagine you provide no information, then even the smartest machine learning algorithm has nothing to do, and the naive investor will be as good as the machine learning. Whereas if you throw 1,000 variables, that's really hard for the naive investors. That's nothing to tackle for the machine learning. So you see how this will have a direct impact. And then, as you saw, it was a sequential game. And so what also matters is how much effort the platform initially put and how good they are at it. So imagine they were already perfectly rating the loans when putting them on the platform, and they were giving an individual grade that perfectly reflects the risk of each loan on the platform. Then the sophisticated investors, they have nothing to do. They have nothing to do anymore. They cannot beat what the platform is giving to them. So that's our hypothesis, and then we bring them to the data, and we are lucky enough to have a data set that's going to cover both naive and sophisticated investors. So we get data from Lending Robot, which recently merged with NSR Invest, and basically it's a machine learning algorithm tool to invest on Lending Club and Prosper. But they do some of the investing, but they also monitor. You can also monitor your own account where you make your own misguided investment strategy on your own. Okay, so we can compare the naive with the sophisticated investors thanks to this data. And what we can also do is compare Lending Club, decision on Lending Club with decision on Prosper, which in itself is interesting. So that's what we do here. I spare you the detail of the regression, but we just want to know whether the algorithm is acting the same way on Lending Club and on Prosper. And the answer is no, which means that the algorithm definitely is taking into account the landscape it's facing. And so if they think Prosper is mispricing the FICO score, is not putting enough weight on the FICO score, then they will offset that. And you see that's the sequential game. They will come in and offset what they think Prosper is doing wrong. And the other thing we check is that the naive investors are not doing the same thing as the machine learning algorithm. I mean, that sounds kind of obvious, but you know, we need to see things to believe in them, and the answer is yes. They do behave differently, so as you can see, the monitored only column have different coefficients. All right, so we know they do different things. The question is, do they overperform? Is the machine learning algorithm overperforming? And the question is yes. So the top line, so that's the charge of rate. Huh? So it's bad for you. So you don't want the line to be high. So the lowest line, the better for you. And what you can see is that the naive investors, they get high charged off, which is higher than the average on the platform, which is just the blue line. And then the machine learning algorithm, they get lower charge off, so they are overperforming what the platform is doing on average. So that's fully consistent with value in the second screening part of the model we were describing. Then we look at whether the set of variables varies. And actually, that's something Lending Club was vocal about. So in November 2014, they reduced by 50% the amount of variables they were offering to the investors. And they basically say, we want to even the playing field. The sophisticated investors are taking all the good loans, and our poor, they didn't call them naive, our poor individual investors, they are getting adversely selected, basically. And so that's bad for them. And so we check that this was actually what happened. So we look before and after this reduction in variables, and we look at the performance of naive investors versus the machine learning algorithm. And so here I've inverted, so here it's good to be high. So that's overperformance over the platform. And so you can see that the machine learning algorithm was overperforming much more before the change than after, because that's making their life harder. They have less things to grasp with. And our last results on thinking about how much effort and how efficient the platform is itself, so Lending Club, is itself at grading the loan, at screening them initially. So that's what we call a ROC curve. So it's a measure of the precision of a test, basically. So you can do that for vaccine, and it gives you the percentage of true positive on this axis. So that's the percentage of true positive, and that's the percentage of false negative. So the perfect test is giving you only this dot here. You're covering 100% of the true positive, and you have 0 false positive. Okay? So whereas if you do it completely randomly, then you just have 50 of each, and that's basically the benchmark. If your test is random, you get this line. And so you want the curve to be as close to the corner as possible to have a good signal. And what we can see here is that so Lending Club is definitely doing some work. They are much better than the random line, which is very reassuring for what Renaud Laplanche was doing there. But then what you can see is that the machine learning algorithm still improves significantly compared to what Lending Club is. So there is a lot of room for improvement from what Lending Club was doing. So that's in 2014. But when you look at the year afterwards, you see that actually Lending Club has improved in its game. So they are learning, the platform is learning, which is also reassuring about their skills. And the more they learn, and the hardest it is for the machine learning algorithm to actually outperform them. Okay, so that's all I wanted to say today. So basically, what we document in this study is that the design of the marketplace, it maps into an allocation of performance between sophisticated investors and naive investors, and that's important when you're trying to attract both this crowd, which these platforms are typically trying to do.